Hi, this is Randy Finney with Right Side of the Chart, and this is a mid to late session update for Friday, September 6, 2024. It's 3:04 p.m. Eastern Time as I'm starting the video. Figured I'd get one out before the close. I'll probably be at my desk up until the close. If anything changes, I'll let you know, but I may cut out earlier. And let me just show you where we're at here and what I'm doing. Somebody asked, I had covered those shorts that I did. I'm sorry, the longs. I came into the day short, reverse, went long, and I'm back long now, watching the market. And I want to say, because I made a reply to somebody, and then I realized, you know what, let me do another video. Quite a few questions today, and so here's where we're at. Let me go to the futures and tell you why. So I flipped back in. I'm still leaning on to going back short no matter what happens before the weekend starts. So that means whether it's in the after-hour session or if I'm around the evening session. But here's where we're at. We're still hugging. This is key support here, 18,490 on NQ, and this is also where that, once we take that out, that's where I believe the big selling will begin to accelerate. We still on the futures have positive divergence. We took it out on the 15-minute charts of QQQ, but we still very much have it here on QQQ and SPY as well. So, and there's a lot of things at support. Now, there's a lot of things under support right now. I know you probably like, Randy, what are you talking about? I'm going to show you the levels. And remember, when I talk about things being in close proximity to support, that you want to give it the benefit of the doubt. So that's what I think there's a decent enough chance. I've seen trading stabilize. I'll get to the 1-minute charts in a second, but all afternoon we've kind of hit a floor just below that 18,490 support level, close enough. And so we may see a surge of buying into the close. And if not, if they close here or lower, that'll determine how much I go home short. Okay, let me just tell you this. No matter what happens today, we could do this. I'm going to go home short. All right, we could do this. I'm going to go home short. I'll take a mild short position based on the collective evidence of everything that's going on. However, right now, I would not be surprised, and I am leaning towards, I wouldn't have reversed back, that they come in today, and we'll see some, I think, buying into the close. I'm looking at a rally of probably 1% to about 2% rally into the close to come back to that trend line again. So this morning when I got out to you, we had a wedge going on, right? Grab this line tool. We had a bullish falling wedge going on. And positive divergence at that point was right here, something like that. And we still have the divergence, but we got rejected at the trend line. And this is also big level right here, about 19,091 that we have to take out in order to clear a bigger move up. So this will determine next week if they can hold this today. And I tell you right now, you're not going to know until at least Monday. If we can go up here, pop this level, pop 19,090 on NQ, we're probably going to go up to that trend line down there. And why? Because a lot of the stocks and sectors I'm about to cover in this video that are either on support right now, such as XLF, financials, and quite a few other things, will have bounced. And those that are just below support will have most likely recovered that support level either today by the close or next week. So I hate to say it, guys, you can hear it in my voice, I'm torn. Moving fast here, and I'm also keeping it down light. I'm not trading heavy right now in the active trading account. I also should reiterate, which I've said multiple times, nothing has changed in my long-term accounts. That's where a bulk of my money is. The longer-term funds that don't trade actively. I'm still bearish and short overall. I'm talking the stock-related stuff. Tech stocks, financials, the Nasdaq 100. That doesn't change. And if anything, today added to the check mark of the bearish case. And how we close today. Well, if we close exactly where we are right now, sure, that even is an additional check mark. If we rally up a little, it's just going to keep things a little bit kind of open or in limbo for next week. But again, if I have to, and sometimes you have to make a decision. Look, you have any time you head into weekend, you have a decision to go flat meaning no positions if you want, or hedge up completely, and go home. We're just talking now the stock market, right? Go home short or go home long. And so that's where we're at. And right now, there's enough evidence, especially, nothing's changed longer term charts. So like I said, if anything, that we had an additional couple check marks for the bearish case today, for sure, especially with the employment numbers, right? Fundamentally, but technically as well. So let me go over everything here. So here we are. We've been all day just slightly under that, but pretty much right on it. You can see 18,510, and I have the level at 18,490. So we're back above or on support. We've pretty much been on it all day. And so that's why I think we can see some bargain hunters stepping in, dip buyers. And again, we're heading into a weekend, so if there's a lot of shorts and they're nervous right now, they may want to cover before the weekend. So that's kind of just near-term stuff. I'd like to see that bounce right up to there, about just shy of that 826 level in the downtrend line. And again, that's going to be about a 2% from where I just reversed if we get it back to a long position, that is. SPY or ES. ES is the S&P 500 ETF. I'm sorry, futures account. Again, a level I've been harping on quite a bit, about 54.40 right there. Again, we're just a hair below that one. And there's we had those wedges this morning. I'm going to get my line tool here. There's the wedges. And we couldn't pop it. You can see there we had a 60-minute candle that tried to get through but never got finalized. That's that white part that we call that a wick on top. It's a candlestick shadow. When it's on top, the skinny part's called a wick. When it's on the bottom, it's called a tail. And so that wick means that on a closing base, they shot it down and you failed to break above the uptrend line. If you did, or if you do, that's going to be a buy signal. Now, what you also need to do, and I'm watching very closely, and this will determine really, if we're going to have a rally into the close today. If we do, there's same target, comparable target, about 54.90, and the intersecting downtrend line give you a pop of about a little less, about 1.25% in the SPY, and that makes sense. Financials have broken down, so I'd expect outperformance in the Q. They're going to probably buy the tech stocks up. Okay, so this is the divergence line. We're just going to clean it up here a little bit. Still very much on the futures, but not on the ETFs. On the 60-minute chart, we have that divergent low. And again, that's just if they can gun it today. And you'll probably see it start to really move if they can get above that 54.40-ish level right there. Otherwise, we're below it, and they could dump it into the close, all right? And then, like I said, win or lose, I'm going to close out the current long as I'm talking now. Came in the day short, went long, covered that, went short, but then decided we were sitting there, and it was about right where I reversed back. I think we can see that little pop today. And again, this is just micro stuff. If anything, may add to some longer term short positions in the other account. Although I'd really like to see how Monday follows through, because we're at such an important level. Let me get to the rest of the charts here. So there's your futures. Those are the levels to watch, and you still have the divergence. On the 15-minute, that's what I gave you earlier today. And we had the same thing, wedges. We've got rejected at this trend line. That's also, you can see this level here, about 448.50 or so is where we've been holding today. You can see all day long. So the selling has stopped. Maybe a little consolidation, maybe a little flagging action. I doubt we're not going to go all the way down and hit the measured target if it is a flag, because that would be the distance of the flagpole. We're already down 2.5%, down until a 5% down day, and that's not going to happen today. It's possible, but I doubt it. And I certainly won't be riding that out if so. So the uptrend line, like I showed you, I've measured, I think it's what I tell you, 2%. Yeah, a little bit. If I grab the bottom right there, I have to grab that level. Independent, if when we hit it now, about closer to 1.5. Just wanted to say that if we bounce up to the trend line the way I have it drawn here, at least on QQQ. And you can see the divergence is now gone. So I've removed that. We made lower lows in the indicators. We never had divergence on the 60-minute chart of SPY. That's one thing to note there. And our QQQ. That's QQQ we're looking at. Let me pull up SPY for you. SPY 60. So the big levels that I'm watching right here, it says 537.01. We're going to round that off. These are the levels I'll be watching next week. I think anything much below 537 on SPY, and the comparable level I have on QQQ is right here, about 444.67. I believe that's where we'll start to see the selling accelerate and just probably run right down through those recent lows. I think a lot of eyes traders will be looking at those lows, but I don't expect to gain any reaction. I expect fully to be short if we start moving down there at that time, and we'll not be covering there. And as I told you, my whole trading plan is all along. This is the kind of bigger picture thing. Here's the weekly chart of QQQ, and remember, this is kind of the where are we now thing. When you go to the shopping mall and there's a map, you walk in any point and it'll give you a little point, little circle with an arrow and saying you are here. Well, this is what I do day in, day out. That's why I keep looping back to this. This is kind of my game plan, and so far the game plan is working out pretty damn well. Sometimes I get a little granular like today, and try to catch a little zig or zag, but the bigger picture couldn't be working out better. This was laid out in advance, late June, that we would top between here and here with a preferred sweet spot to the top of the range, because that would line up better with the Fibonacci projections and Fibonacci targets. That's what we did. Stopped right within 1.5% of the top, had our first leg down, hit the 200s, which I've been calling for a pullback to, and told you they would buy the 200s. We actually reversed the lows. So this is the kind of the map. And now the map doesn't have to continue to work out, but the fact that we have now capped out just shy of where I told you I would, my trading plan back here when I went long here, told you I started scaling out of those longs into shorts along here up to that point, and said I would stop out if we went much higher than where we went. So it was the top of where that whole map was, kind of that mental map in my head, and again shared here on the site. And so we reversed. And so my point is, so far things are playing out, and that reinforces that this outlook so far seems to be the right one. And now the tough part is today, because today I'm going to go over the levels we're at. They are certainly not buying it up yet, but they've stopped it cold at key support levels. So one of those levels is right here. Remember this T1 right here? This is T1, 449.70. We parked it on that week. That's exactly where we parked. Remember, this was our first, T1 right here. There it is. Now you can see it. And it wasn't a random number. It was this right here. It was a previous all-time high. We broke out. We back tested for 3 weeks, and then we rallied up. And then so we hit that. We hit the trend line too. And that's where we parked that week. Next week we went down here. We hit the 200 days in T2. And as expected, we had a tradable bounce, double-digit bounce. And now we're back to that support level. So that's what I wanted to impress right now, is that although, I still see this, and 100% will, longer-term accounts still position that way. Just very near-term, you have to acknowledge that the market is at price support. I just dropped down to a daily chart. That's pretty decent price support. It's at the uptrend line on QQQ right here, and we're still above the 200-day moving averages. So until these 200s get taken out in those recent lows, you just can't completely write off the market. So my degree of confidence on this whole, how this thing's going to play out will go up a lot higher when we take undercut, especially in both QQQ and SPY, the 200 days in those recent lows right there. Right on SPY, which you can see right here. And so on SPY, we had recently broken out of this trading range. I was highlighting that last week and this week, saying that breakout, favoring a downside break, and whichever way it broke would determine the next tradable trend. And so far, again, this helps that map. Where are we now? That's what's happened. And so minor squiggles or kickbacks aside, I think we'll continue to do that in the coming weeks here. And now the thing about it, we're less than 5% off the highs in the S&P 500. So again, caution needs to be warranted on the short side. It's still things looking good so far. This was just a beautiful, beautiful, technical, the S&P 500, the way it's trading to the technicals. Primary uptrend line, breakdown, back test, rejection, down to, remember, intraday, intramorning, we hit the 200s, and with a lot of stocks, I think even the S&P, the futures were there. We hit NQ, hit my 6th price target on the daily chart at that to the button. So we were at support on so many things. That's where we got the bounce, and look where they rejected it, right on the back test of the uptrend line. And pretty much, I said, almost a divergent high. We never made a new high, but for all intents and purposes, close enough. And again, that's the thing. We're only within 5% of that high right now. So not time to start high-fiving yet or getting super aggressive short, especially heading into weekend. When we take out the 200s, if and when we take those out next time, and this level right here, that key reaction low, the odds are going to shoot up substantially that we're going to go down to my longer and deeper targets. Again, my more aggressive targets calling for a drop of roughly 50% in the NASDAQ, and maybe more over time, but right now those are in the S&P. The drop is, what is it, to T6, only about 27%. Again, that's these no, I'm sorry, T7's down here. I thought that was a little tame per target. 38% drop. And that's just calling for a, test of those 2022 lows right there, and primary and long-term uptrend line and all that. So again, long-term stuff right now, very near term, as I showed you. You've got the indexes at the futures are at or very close to key support levels. There's those gaps on SPY, but that's again why I look at the futures as well. And you can see on the volume price histogram over here, see these big red bars all here. This is where the majority of trades. So there really should be, and I will add it right now. I like to use these volume price histograms. That tells you that in the past few months, this is where almost all the trades in the S&P 500 occurred. That's why I do think we start getting down lower, you'll just start to waterfall down. But and that good chance that'll be next week. We'll just have to see if they can hold it here and if they're going to come in and try to buy it. All right, let me give you a couple other reasons why the market has stopped here and why we could bounce into the close. So NVDA, obviously, I covered that in the previous video, very big one. And again, I always say if you have to squint to see if you've broken down, you want to give it the benefit of the doubt. And so we're below the trend line, and that is net bearish. So I'll say it again: a breakdown's a breakdown. But what all that matters is how you close the day on a daily time frame. So all they have to do, and you can get real close and nitty gritty here. You only have to rally up. That's even a fraction of percent. That's 0.7, 0.9. So we're for all intents and purposes, we're on the trend line. We're a hair below it. What you want to see to really solidify a sell signal is a solid daily close. You get a red candle that looks like this or better, that's gone. And then you have the next support there in the 200 days and the recent lows. So this is all the kind of the last tier to support. And again, you've had my targets for NVIDIA since late June as well. And this is simply, and it's also playing out as expected. 200, call back to the 200 days. Price support and the primary uptrend line all hit, bounce as expected, get back short. We shorted back on the bounce to the downtrend line, and then once T1 goes, the 200 days go, the trend line goes, it should be a pretty quick swoon down to the next targets, and that's it. So to reiterate, you just have to exercise some caution right now, despite the fact NVIDIA just looks like it can't catch a bid, because this is where they bought it last time, and they may buy it again. And if they don't, you know what, next week we'll know. And again, these targets are so big that, we can, as soon as we, wait and see if this level goes, this is where I'll get aggressively short NVIDIA again. I told you I will not I told you I was using puts heading up into earnings and still have those puts, and very happy with those, very profitable. But I'm also waiting for the right time to aggressively reshort the shares. Covered the other day when we hit the trend line for the reasons I told you, because that's trend line support, and we're right there. We're right where I covered, so I can get back in at pretty much the same price. But let's see what that does. So there's NVIDIA, and again, to me, a big one, Broadcom. Broadcom has clearly broken down below the trend line, so that's going to be a sell signal. But remember, we broke down one day there, and we hit the 200 days, and they bought it up. So the way this game works, guys, is some people see this. It's like those Rorschach ink blot tests. Excuse me. Where we all see different things. We all see what we want to see. Some traders see this when they look at a chart and only see the 200 days. Some see this. They see the uptrend line. Some see the 200-day simple moving average that I have on red, and that's where they bought it. Some see the 200 exponential. I'm sorry, that's the exponentials in red, the higher one, the simples in blue. And I look at them all. And so I say, you know what? That's a breakdown. Sell signal will probably go lower, but it's going to be even better when we break the 200s, and then of course then opens the door to the next target. And so the point is, we came close to the 200 again. They may step in and buy it, try to close that gap. If they do that, if they just reflexively bounce it off the 200, you're going to be back above the uptrend line. So then this whole thing is, guess what? A bear trap. Last time we did that, and if you shorted the break of the trend line just because that's all you were watching, you watched your short position go underwater by about 37% if you didn't cover it. So, okay, that's why I'm at. So I know I'm being not redundant. I'm just covering a lot of different things and telling you that my long-term outlook hasn't changed, but near-term this could go either way. And I'm not going to bet it heavy. I'm just going to try to game a little bounce into the close right now, see what we can get. All right. So the other things are financials. As I've been stating recently, I didn't even have to turn on the TV or read any articles to hear. I can already, I've done this long enough to know what the bull speak is going to be, and I'm talking about those in the, financial industry that have a vested interest in being permanently bullish for their clients. They manage, most of them manage long side only funds, via hedge funds, mutual funds. Asset managers are typically not bearish. They don't want to tell their clients the market's going to drop. They wouldn't know it, a bear market if it fell from the sky. And most of them, not all of them, guys. There's some good ones out there. Please understand that. But generally speaking, that's how the industry is geared, right? That stocks go up, buy and hold, don't time the market. So what I'm getting at here is one of their strongest cases to be made recently was that, hey, this is just a tech correction, nothing more, nothing less. Tech got ahead of itself, a little overvalued. It's healthy sector rotation. The S&P is doing good. The financials are at all-time highs, et cetera, et cetera. Well, as I told you the other day, financials broke down. And however, I also told you this is the first and what I call my BOD, benefit of the doubt support. That was the previous all-time high. We danced under it for about almost a week there and broke out, and this is simply a back test. So from the glass half full perspective, it's a breakout and a back test, and they may step in and buy it. Now, I don't think so. Even if they do, I think ultimately it goes. I made my pretty clear on that, and this is probably the last pillar of the market to go, and lest we not forget what happened back in 2021, the last bear market. The NASDAQ 100 and all things tech peaked back in, including the semis and everything, back in November, late November, right? But the S&P 500, and you got it, things like financial, healthcare, all that, they didn't peak until the early January. And so that's almost playing out the same here. And I say history doesn't always repeat, but it often rhymes. And so we're seeing the same kind of thing there. So this is, to me, I don't want to use the word, the final pillar to crack we need a little more evidence, and that would be, the financials taking out that support. And by all metrics, I think they're going to do it. Like I said, I'm still even in my active trading account, that short I didn't cover the financials. I've got the futures for the financials, and I have my swing accounts. I'm short there, so I'm not going to try to game a bounce here. If they bounce, I'll just use any bounce to add to strength. And let's take a look at that. JP Morgan already gave up the BOD support. See, this is that comparable level on the biggest bank out there, the biggest of the financials. And it's at 216.31, so that's already taken out. And that's big. You kill the leader, this is the 5-star general, then you've pretty much demoralized the troops. Visa, MasterCard just dancing, flirting with it, ready to break any minute. Bank of America, big breakdown today. Berkshire finally broke down yesterday. So I'm getting check marks across the board, guys, here. And so, again, I want to reiterate my both near-term and longer-term outlook, and whether I can game a little bounce into the close or not. Like I said, I'm going back short. So you have the levels to watch. Let me see, what else is there? Semis. Semis have effectively hit now. Gave you, we had sell signals, breakdowns back here, but remember we covered all shorts here. It wasn't a random event. It was both price support. Here, I gave you targets more recently on the weekly chart of SOX right here. And weekly or day, it was a weekly. When we were right up here after the bounce, we reversed. We went long the market, everything, all things tech, all things, everything there. And then gave you a target. We hit T1 just the other day. Here, I'll drop it down to a daily. We hit T1, and now we've effectively hit T2. But my point is, this is support too. This is the primary trend line. This right here, the blue trend line, is the primary trend line off the October lows. It's the same trend line we hit recently at the August 5th lows when we covered all shorts and went long, and we're there again. So I've just spent the bulk of this video showing you that all the things, the most important things in the market to me, which are of course the large caps, the S&P 500 and the NASDAQ 100, the semiconductors, and a couple key stocks, the leading semis like Broadcom and NVDA, and the semiconductor sector. They're playing out as expected, and these are support levels, remember, that already got checked. So I don't expect another double-digit bounce off here. Is it possible? Absolutely. Anything's possible. If they start rallying the semis, where do I start to become concerned and want to start to cover my long-term shorts in the semis? It's a downtrend line off the highs. T1 was, this price resistance now. I'll talk on it if and when that happens. I don't think it will. I expect at most one little reflexive hurrah today. I'm kind of open to next week. I'm going to go in short but relatively light in my trading account. And then Monday, futures are tanking down Sunday evening and we're in crash mode. I'll probably add then. If Monday morning, they're still down, and again, I'll get something out to you. I'll add. Otherwise, we could have a little bounce here and maybe come back test the 200 days in that level there. So I feel more comfortable waiting to aggressively re-engage the market on next week, depending on how these levels go. And then again, lights out pretty much with everything. The S&P 500, NASDAQ 100 semis, undercut of the recent lows, NVIDIA, all that, it's going to have done the trick because it'll, taken out the 200-day moving averages on most of them. It'll take out the primary uptrend lines. And like I said, it should be at that point, whether that's next week or 3 months from now. That's the point where we'll probably have the next swoon down, and it'll be a quick one. You can see if you look at, I like my volume price histograms. I think you can see it here. I'm going to turn up the volume for you, the color, brightness. And so this is SOX again, semiconductor. There's T3, our next target. Look at that thin zone right here. A thin zone means very few traders. So the only trades that occurred over the past, this is 2.5 years, almost 3 years, and those are the only trades. That's very few. So most people bought here, and that's a massive amount of folks. Psychological, huge market important. Remember, it's semis. NVDA has been the poster child of this stock market. It's been the almost exclusive driver, not the exclusive, but largely, primarily the primary driver of the rally over the last year or so. Okay, and that's been it, and it's spilled over to all things tech. And I don't care if your company sells okra on the side of a stand on the side of a country road. If you went public and you had the word and you just threw in the word AI in your annual report, oh, we're going to use AI to start enhancing sales and all that. People were buying it. It was the .com bubble all over again. So what I'm saying is all those folks here, these are kind of the, I'll use my words carefully. It's retail crowd, even a lot of pros that chase that AI bubble. Bottom line is, guys, they may hold that and rocket on up, but if they take that level out, it's going to be a quick swoon down to T4 because that's a thin zone. Thin zones work just like gaps on a stock. A gap has no trades at all, so you're going to see a zero volume of price histogram bars. But you can see really the volume of price histogram bars pick up actually below my fourth target. And so we may just blast on right through T4, maybe even go down to T5 if and when that happens. Because again, you're going to have just a massive amount of folks that bought into this whole the stock market will go up forever. AI is going to change the world. Don't worry about valuations because NVIDIA just can't. Their biggest problem is counting all their money and they have an order backlog that's going to take years to clear. Blah blah blah. So, in game, all that stuff will not matter anymore if those support levels break. And I think they do. I think. Believe me, if I thought it back here, this is playing out exactly as these patterns should. Bearish rising wedge break, kickback rally off support, next leg down, and there it is. All right, I believe I'll wrap it up here. Let me just double check and see if there's anything I missed because this will most likely be my last video for the day. Yep, you got the U.S. dollar, Japanese yen pair is cracking. So it's something else. It's again, you have to squint, but it's there. It's below. We were deeper today. You can see this candle, but we're below there. And so if these support levels give way next week, which I'm leaning towards, we can see a quick swoon down. Remember, we break that. That's a nice technical level. The yen is going to drop all the way down to this level. That's going to be a pretty, it's going to, spark, most likely spark some selling in the market with talks of further unwind of the yen carry trade. So, and like I said, it's just like NVIDIA, just like Broadcom, it's below that support level right now. So we might not get, and looks like now if I'm 337, you know what, I don't think that bounce is going to materialize. I'm going to stop the video. We've got 13 minutes left in the trading day, and like I said, I'll definitely see enough right now to go home with at least a mild short exposure in the trading account, and the same I've got a pretty moderate short exposure in all the longer term accounts, and I don't see any reason at this point in time to change that outlook or positioning. All right, guys, hopefully that makes sense. And like I said, today was one of those days, started out where I thought we could get that bounce based on those technical setups and the fact that the market might cheer the fact that it's pushes the Fed closer towards that 50-point cut everyone wants. However, I'm seeing the narrative change, and that's important too. Remember, over the last year, good news on the stock market or good news on the economy was good news, and then bad news was good news because it would help, or so they thought. They kept saying, oh, the Fed will cut it the next meeting. The Fed kept putting it off, but the market was cheering any type of weak economic reports, and then they also cheered the good ones. But lately, we've been seeing a change of character here where all of a sudden they're selling even though it solidified a rate cut at the next meeting as the first thing it did, now it seems that market participants, don't want to see any more weakness, especially in the jobs market, and that's kind of the trend, and the trend was reinforced today. So I will stop it here. This is Randy Finney with Right Side of the Chart. Have a great weekend.